This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performances do not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk. There's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading.
Good afternoon, traders. I'm Scott Norris here with your FOREX report. Today is Friday, January 26, 2007. After a rocky start at this week's open, the U.S. dollar found incredible support in the broad market in the final 3 days. Tuesday morning, it looked as though the greenback could be setting up for a big decline on the week. The U.S. economic calendar was very bare, with data stacked up in just the final 2 days. However, it was disappointing data from other major economies that allowed the buck to fight back ahead of U.S. data and begin a short-term bull run Wednesday morning. The Bank of England released the minutes from its meeting this month, where it surprised with a rate hike. However, upon hearing that the vote was a mere 5-4, traders began to take profits on long pound sterling trades. Meanwhile, disappointing CPI numbers from Australia have really deflated its currency as well. The IFO survey from Germany also came in below estimates. However, the euro has been on a slippery slope for several weeks. This week's most important U.S. releases were new and existing home sales for December. The numbers didn't look bad overall, with existing sales slipping very slightly and new home sales surging nearly 5% for the month. Durable goods orders for the same period also beat expectations, rising 2.3% in the core number. Of course, these upside surprises only lent the dollar strength for a short time due to technical gridlock. The greenback is finding serious resistance in many pairs at present in the form of moving averages, trend lines, and even multi-year highs against the yen. As we head into big week of data next week, it seems reasonable for dollar bulls to now hold off on further aggressive buying at such levels. Next week, we believe it's still anyone's game, and dollar bulls or bears could come out on top. Now on to the big picture. Dollar bulls are still counting on the Goldilocks scenario to pan out, but may not need a picture-perfect landing to keep the currency's head above water. Economic data surrounding several other major currencies suggests that the Fed may have company in keeping rates on hold this year. Assuming that the U.S. does not lower rates in the next 6 months, we may only see the yield gap narrow with the Eurozone. Furthermore, rate hikes from the ECB are now considered overdue by the market. This means that unless the bank becomes overly aggressive in the near future, rate hikes may only keep the euro from free-falling rather than sparking big rallies. If we see U.S. data really shine in coming months, we may see more than just buoyancy from the greenback. As long as other key central banks outside the U.S. do not throw us any curveballs, we could move into broader ranges on many of the majors. We saw such ranges form through Q2 and Q3 last year and should not rule out similar activity if this scenario plays out. Till next week, have a wonderful weekend. Take care.